This is your technical update from the LMAX Exchange Research and Analytics Desk for Thursday, January 14th, 2016. Euro dollar. So the euro's taken a bit of a back seat this week, with the market trading in a consolidation while the rest of the market is seeing some volatility. At this point, the key levels to watch above and below come in at 110.60 above and 107.11 below. 110.60 could be a potential lower top, with the market confined to a broader downtrend, and this will be helped to be confirmed on a break back below 107.11, which would then expose the December 2015 base at 105.21 further down. At this point, look for rallies to therefore be well capped, with only a break back above 110.60 to compromise the current downtrend. Sterling dollar. So cable has dropped down to its lowest level since 2010, with the market trading at multi-year lows and tracking in deep oversold territory. At this point, there is risk for some form of a bounce in the sessions ahead to allow for these heavily oversold studies to unwind, and this could result in a break back towards the 150 level in the sessions ahead. But we would need to see a break back above and a close back above the high that we saw on Wednesday, which comes in at 144.76, to help strengthen this outlook and open the door for the onset of a correction. Still, overall, the downtrend remains firmly intact, and a break all the way back above 152.40 would be required to negate the current downtrend. Dollar yen. So dollar yen is in the process of consolidating off recent lows, though the market is now trading within a stone's throw of that key August low at 116.12. At this point, deeper setbacks are favored towards the 116.12 low, while any rally should be well capped towards the 120 handle. Ultimately, dollar yen favors downside and only back above the 120.76 area or the 120.65 area would take the immediate pressure off the downside. Euro Swiss. So finally seeing some volatility in Euro Swiss after the market had been showing a contraction in volatility over the past several months. We had a surge in Euro Swiss on Wednesday, with the market trading back above some key resistance around 109.50, and this could open the door for additional upside towards critical resistance in the form of the September peak at 110.50. Ultimately, the recovery structure here is intact, and a break above 110.50 will open the door for the next key upside extension towards the 115 area further up. Any setback should continue to be very well supported, with only a break back below 107.15 to compromise this constructive outlook for Euro Swiss. Aussie dollar. So Aussie dollar is trading lower, with the market remaining under pressure and tracking just shy of the key multi-year base from 2015 at 69.08. A break below that level would open the door for a fresh downside extension, potentially towards the 65 area further down. But at this point, daily studies are looking a little bit stretched, so there is risk, even if we see a retest and break of 69.08, for some form of a bounce before the market decides to head lower again. Any rallies, however, should be very well capped now towards the 72 handle, with only a break back above 73.85 to compromise the bearish outlook for the Australian dollar. Dollar CAD. So dollar CAD continues with its impressive surge. The market is really going parabolic at this point, with daily studies tracking in heavily overbought territory, and this also complements medium-term studies that are overbought, as the weekly and monthly are also tracking well overbought. At this point, the market has traded up towards 144, but is now looking again heavily overbought, and there is risk for some form of a serious correction in the days ahead. Look for a break and close back below the low that we saw on Wednesday at 141.87 to strengthen this outlook and accelerate declines for, again, some form of a correction over the coming sessions. Any setback should start to find some support into the 138 area, where the market might start to want to find a higher low ahead of the next major upside extension. But while the constructive outlook remains firmly intact, there is this risk for some form of a correction in the sessions ahead. If we do see any additional upside beyond the recent peak that we saw today at 143.82, just shy of 144, any gains from here should realistically be well capped into the 145 area in favor of this meaningful correction in the days ahead. Kiwi dollar. So Kiwi has seen some accelerated declines, with the market now closing in on some key support going back to the November low at 64.29. At this point, deeper setbacks are favored, eventually below 64.29 and towards a retest of the 2015 base closer down towards the 62 area. Any rally should be very well capped in this market up towards the 66 to 67 area, while ultimately only back above 69 would compromise the bearish outlook for Kiwi dollar. SPX 500. So the S&P 500 continues to extend its impressive declines, with the market now closing in on a retest of the critical August flash crash low at 1834. At this point, any rally should be very well capped towards some previous support and outturn resistance around 1993. That's the low that we saw going back to the 14th of December. Only back above 1993 would really take the immediate pressure off the downside in this market. Gold. So despite some recent pullbacks in gold, the setbacks are classified as minor setbacks, with the market looking for a higher low now. The recent break above 1100 that we saw the other week has suggested a shift in this outlook and a shift in the structure, with the market now looking for a higher low and fresh upside extension back above the recent highs in the 1112 area, potentially accelerating back towards 1200 in the weeks ahead. At this point, only a close back below 1070 would force a shift in this newly adopted bullish outlook and put the pressure back on the downside towards those multi-year lows from 2015 at 1046.